Welcome to the III Licentiate IC-01 Chapter 2 Explainer video from the Insurance Domain Training Center. We have launched this licentiate video series to support candidates who are preparing for the licentiate examination conducted by the Insurance Institute of India. Our objective is to help you understand the concepts through simple explanations, practical examples, and exam-oriented discussions that make your preparation easier and more effective. In this video, we will cover Chapter 2, Risk, Peril and Hazard, Risk Classification and Rating. Before we begin, please take a moment to read the following disclaimer.
Before we begin, please take a moment to read this important disclaimer. This video is an independent educational resource created by the Insurance Domain Training Center to help learners understand the concepts covered in the III Licentiate exam IC01. We are not associated with or authorized by the Insurance Institute of India. For examination purposes, please refer to the official study material and any instructions issued by the Insurance Institute of India, as those remain the authoritative and final source. Thank you. Let's begin our learning journey. This learning video is developed by drawing inspiration from Richard Mayer's pre-training principle. For each section, we first provide a brief overview of the key concepts. Once the entire section is complete, we revisit the same concepts with visual explanations and practical examples. This two-step approach helps you understand the big picture first and then reinforces your learning through examples. For the best learning experience, keep your Insurance Institute of India Licentiate IC01 textbook with you and follow the same chapter as you watch this video. Finally, test your understanding by attempting the chapter questions before looking at the answers. Now, let's begin. In this video, we are covering Chapter 2, Risk, Peril and Hazard, Risk Classification and Rating. The objective of this chapter is to introduce you to the concepts of risk, peril, hazard, and understand the differentiation. You will also learn how risks are classified by insurer and how it helps in underwriting and rating. For easier understanding, we have divided this chapter into 3 sections. The first section covers characteristics of insurable risk. The second section explains peril and hazard. The third section focuses on risk classification. Let's begin with the first section, characteristics of insurable risk, and see what it covers. In the last chapter, we discussed that insurance companies generally insure pure risks, not speculative risks. Now the question is, are all pure risks insurable? How does an insurance company determine whether a particular risk is insurable or not? This section explains the 7 characteristics or filters that insurance companies consider when determining whether a risk is insurable or not. These 7 characteristics are listed in the image here. Let us learn about each of them.
Welcome to Section 1. We are going to understand the characteristics of insurable risk in this section. You know, there's this really common misconception out there that basically any potential financial loss can be insured. But actually, it's not that simple. For example, the destruction of a factory during wartime. That is a pure risk, but it's fundamentally uninsurable. To avoid absolute financial collapse, an insurable risk really has to check these 7 strict boxes. So let's look at how a few of the most crucial ones actually play out in practice. Take the very first rule. For instance, homogeneous exposure units. Imagine you have 2 identical cars. One belongs to a doctor with, say, a 5-minute daily commute, while the other belongs to a taxi driver who's logging hundreds of miles a day. Grouping them into the exact same risk pool creates something called adverse selection. Basically, it completely ruins the math. Insurers really need large pools of truly similar risks to predict their losses accurately. Now, risks must also be perfectly independent. I mean, you definitely don't want a single fire wiping out an entire tightly packed compound, triggering a massive chain reaction of payouts, right? Furthermore, expected losses have got to be calculable strictly in monetary terms, because while a valuable family possession obviously holds immense emotional value, underwriters can only operate on tradable financial realities. subjective sentimental value simply cannot be insured. Then there's the whole requirement of the fortuitous event. Essentially, a covered loss has to be a complete accident. I mean, if a loss is basically guaranteed, like the gradual wear and tear on your roof over the years, well, it's not really a risk anymore. It's an expectation. And insuring an expectation just means you'd be pointlessly trading dollars back and forth with the insurance company while paying all their administrative expenses on top of it. No thanks. Rounding out the list, the loss must be absolutely definite in terms of time, place, and amount. And honestly, this is exactly why insurers really dislike covering things like mysterious disappearances. Coverage also needs to be economically feasible for both parties involved. And crucially, this is the make or break requirement. It has to involve non-catastrophic events. Events of a truly devastating scale, such as a nuclear meltdown, can overwhelm even the largest global reinsurers, making them effectively uninsurable. So that begs the question. If a risk actually manages to pass all these strict tests, how does the underwriter go about evaluating the actual mechanics of a potential claim? We will discuss that in Section 2.
Now you have completed the brief overview of a section. Now let us revisit the same concept with more details, with visuals and explanation. Let us jump in.
You buy a new scooter and want to protect it, so you get an insurance policy. But if you buy an ice cream cone and immediately drop it on the sidewalk, you can't buy a policy to replace it. Both situations cost you money, but they are treated entirely differently. Insurance is designed specifically to handle pure financial risks, situations where you can only lose, not gain. But even then, companies can't just blindly accept every single financial risk people bring to them. To figure out what they can safely cover, an insurer runs every proposed risk through a strict evaluation. This graphic represents that process as a 7-level filtering machine, where a potential risk enters at the top and has to pass through 7 specific characteristics. These strict rules are not there to trick customers or deny help. The company has to ensure the math remains stable. If they accept the wrong kinds of risks, the money pool can dry up, making it impossible to pay valid claims for everyone else. The first filter requires homogeneous items. Think of a doctor driving to the hospital versus a taxi driver using the same car for 12 hours a day. Grouping these different risks together would throw off the pool's balance. As this animated diagram shows, insurers need a massive group of similar risks. The more identical risks you group together, the smaller the gap becomes between expected and actual losses. But even if those risks are perfectly similar, they still have to pass the second filter, independence. If one person's loss automatically triggers another person's loss, a single bad event could drain the entire pool. This illustration shows exactly why insurers look for independence. If a fire breaks out in a tightly packed compound, it can spread from unit to unit, creating a massive chain of claims. Without similarity and independence, unpredictable spikes in claims would completely overwhelm the insurance company's capacity to pay. Next, we evaluate the nature of the claim itself. Filter 3 requires the loss to be calculable in exact money terms. Losing a family member carries a heavy emotional burden, but emotions can't be measured on a financial spreadsheet. Because emotional loss is completely subjective, insurers have to maintain objective standards. They only focus on the financial value of property or life because that is the only value they can objectively measure. Filter 4 requires a definite loss. Insurers need clear proof of the exact date, place, amount, and cause of the loss. A verified car accident passes this test, but a mysterious disappearance without evidence does not. Filter 5 demands that the loss results from an entirely accidental event. In simple terms, the chance of it happening must be uncertain. It should be neither impossible nor certain. It must be unforeseen. This illustration shows a sudden rainstorm soaking a shipment of goods. That is an unforeseen accident. But if the loss is guaranteed to happen eventually through normal wear and tear, it does not qualify for insurance. If a claim can be measured in rupees, verified with evidence, and results from an accidental event, the insurance system remains financially stable. The final two filters deal with the practical limits of running an insurance business. Filter 6 is economic feasibility. The premium a customer pays must be affordable, while the cost of managing the insurance must also be practical for the insurer. This comparison shows small everyday losses, such as losing inexpensive pens. If you tried to insure them, the administrative cost of processing thousands of tiny claims would be so high that the premium would cost more than the pen itself. Finally, Filter 7 ensures that the risk is not catastrophic. Some disasters cause such massive damage that no single insurance company, or even the specialized reinsurance companies that insure insurers, can absorb the losses. This illustration shows exactly the type of risks insurers must avoid. Widespread destruction caused by war or a nuclear incident would generate so many claims at the same time that the entire insurance system could collapse. An insurance company operates as a carefully balanced financial safeguard. If it accepts guaranteed losses or global-scale catastrophes, it simply won't survive to protect anyone else. Let's bring back our 7-level checklist. When a proposed risk successfully passes through every stage of this filtering process and receives the approved stamp, it means something very important. It means the risk has been grouped with thousands of similar, independent risks. It means the potential loss can be measured in monetary terms, verified with facts and results from an accidental event. Applying these 7 characteristics transforms insurance underwriting from a complex judgment into a logical, fair, and financially sustainable system for protecting people's financial future.
We are currently in Section 2. So far, you have understood the characteristics of insurable risk. While we discussed what is risk in previous lesson, we are introducing 2 new terminologies here, peril and hazard. In this section, you will understand what is peril and hazard and how it impacts insurance business, underwriting and rating. You will also understand how it closely connected to a risk.
Let us understand the concept of risk, peril and hazard. You know, in everyday conversation, we all kind of use risk, peril and hazard interchangeably. But to an underwriter, mixing these up is a serious mistake. So first, let us speak about risk. Risk is simply the overarching possibility that a financial loss might actually occur to a given asset. Second on the list, we have the peril. If risk is the possibility of something happening, the peril is the actual physical agent that causes the damage. We are talking about fire, flood, earthquake, or even a thief. When you're buying an insurance policy, you're generally buying protection against specific perils. And third is the hazard. Now it's important to remember that the hazard itself doesn't actually cause the loss. Instead, think of it as a multiplier. It's a specific condition or circumstance that makes a peril more likely to occur or makes the resulting damage much more severe if it does happen. Let's look at a practical example. Suppose our peril is fire. A building constructed entirely of wood is obviously a much greater hazard than a structure built with cement and steel. The wood didn't start the fire itself, but it certainly increases both the probability and the severity of the loss. This 3-part relationship is basically the lifeblood of premium calculation. An underwriter identifies the risk, such as a property. Then they identify the covered peril, such as flood. Finally,
They evaluate the hazards, such as the property's proximity to a nearby river. Mastering this formula is exactly how differential rating is achieved in the insurance industry. But here's the thing. Evaluating a single hazard for a single property is one thing. An insurance company, however, deals with millions of exposure units. How these risks are classified.
Now you have completed the brief overview of a section. Now let us revisit the same concept with more details, with visuals and explanation. Let us jump in.
Meet Rahul. He's worked hard, and today he's standing in front of two of his biggest achievements, his new home and his shiny scooter. But the thing about owning valuable things is the quiet worry that comes with them. Rahul knows that, at any moment, something could happen to take them away. This breaking coin illustrates a concept called risk, the simple possibility of losing money. Risk isn't the fire or the accident itself. It's simply the possibility that Rahul may suddenly have to spend money because of an unexpected loss. To deal with that possibility, an insurance company has to look beyond the general worry and identify the exact events that could cause the loss. Simply put, because these things have value, Rahul constantly carries the risk that they may one day cost him money. To understand that risk, we have to look at the real-world events that actually damage property. In insurance, the specific event that causes the damage is called a peril. This split screen shows two common examples, fire and rising floodwater. Both are perils because they are the direct causes of loss. The same applies to Rahul's scooter. A traffic accident or a thief stealing it are perils that can cause a financial loss. So, while risk is the possibility of losing money, the peril is the fire, the flood, the accident, or the thief that actually causes the loss. Knowing the exact peril is extremely important. Most insurance policies pay claims only when the damage is caused by a peril that is covered under the policy. But is the chance of a peril affecting everyone the same? Not always. Often, there's a specific condition or circumstance that makes a loss more likely. This is called a hazard. A hazard is any condition that increases the likelihood of a loss or makes the damage more severe. Consider two houses. House A is located in a dry area. House B is built beside a river. Being close to the river is a flood hazard. Now suppose House A is made of concrete while House B is built of wood. The wooden construction becomes a fire hazard because it can increase the severity of fire damage. The same idea applies to Rahul's scooter. One scooter is securely locked in a safe parking area. The other is left on a dark, deserted street. The dark street doesn't steal the scooter, that's the thief's job. But the darkness is the hazard because it makes the theft much easier. Hazards are the conditions that help insurers determine how risky a particular situation really is. When we look at these three concepts together, we can clearly see how they are connected. It all starts with risk, Rahul's possibility of suffering a financial loss. Next comes the peril, the actual event that causes the damage. Finally comes the hazard, the condition, such as wooden walls or poor parking, that increases the chance or severity of the loss. Risk is the possibility of financial loss. Peril is the direct cause of the loss. Hazard is the condition that makes the loss more likely or more severe. We can't always prevent a fire, flood, or accident from happening, but we can often reduce the hazards around us. When Rahul moves his scooter from a dark alley to a well-lit parking area, he is removing a hazard. By managing the hazards we can control, we reduce the likelihood of a peril causing a financial loss, helping protect both our property and our finances.
Welcome to Section 3. In this section, you will be learning why risk classification by insurance companies is necessary, basis on which risk can be classified, and what factors that insurance industry considers for classification. It will connect with what you learned in previous section related to hazard. Hazard is the basis of risk classification. Let us study further on this subject.
We are in Section 3, Risk Classification. We understood what is hazard in Section 2. At its core, hazard is actually the foundation of risk classification. Risk classification takes similar policies and categorizes them into distinct groups based on the hazards they present. This dramatically speeds up the underwriting process. For example, suppose you have a group of nearly identical buildings. Some are used as residential homes, while others are used to store highly flammable manufacturing chemicals. Classification allows the underwriter to immediately charge a lower fire premium for residential buildings and a significantly higher premium for hazardous warehouse, all without developing a brand new mathematical model every single time. Now, you can't just group risks based on intuition. To build a proper and legally defensible classification system, insurers carefully balance 5 key factors to ensure the system is functional, fair, and legally compliant. First, they need sound actuarial factors. This means the classification characteristic must statistically predict losses. For example, a person's age has a direct statistical relationship with life insurance mortality rates. Education level, on the other hand, generally does not. Trying to classify life insurance risks based on education would fail this actuarial requirement. The system also has to be objective and fair. Objectivity ensures that different underwriters will arrive at the same classification for the same risk. Fairness means that similar risks pay similar premiums. It would be highly unfair if a low-risk homeowner ended up subsidizing the higher risks associated with commercial properties. If that happens, the best risks will leave the insurance pool. Eventually, the entire system could collapse due to adverse selection. Furthermore, classification systems must remain dynamic. They cannot become outdated. The insurance industry has to constantly adapt to changing environments. What was relevant 10 years ago may be completely obsolete today. A good risk classification system quickly incorporates modern realities, whether it's emerging cyber risks or safer 4-lane highway designs that reduce accident frequency and transportation losses. Ultimately, everything comes down to simplicity and maintaining a careful mathematical balance. The objective is to create a risk pool that is large enough for the law of large numbers to work effectively, while still being detailed enough to accurately reflect the unique hazards of different groups. If the classification is too broad, fairness is lost. If it's too complex, administrative costs become excessive, making the insurance product economically impractical. As our physical and digital environments continue to evolve with artificial intelligence, climate change, autonomous vehicles, and countless other innovations, these traditional principles will also continue to evolve. New hazards will emerge, and underwriters will constantly refine their models to keep insurance both fair and financially sustainable. It is a fascinating and highly complex puzzle, one that the insurance industry continues to solve in real time. Well, that wraps it up.
Now you have completed the brief overview of a section. Now let us revisit the same concept with more details, with visuals and explanation. Let us jump in.
Imagine you live in a quiet, standard suburban home. Now imagine your next-door neighbor is a massive, highly active industrial warehouse. Sparks are flying, and heavy machinery is running around the clock. The actual fire risk between these two buildings is completely different. If an insurance company tried to charge you, the homeowner, the same premium for fire insurance as that hazardous warehouse, you would probably think it was unfair. It makes no mathematical sense for a safe, low-risk property to share the financial burden of a highly hazardous one. This creates an immediate reaction in the insurance market. People who are less likely to suffer a loss will not want to subsidize those with much higher risks. They will simply leave the insurance pool. In insurance, putting everyone into the same category without considering their level of risk creates a heterogeneous risk pool. Low-risk and high-risk participants are mixed together. As the safer policyholders leave, the insurance pool changes. It becomes concentrated with mostly high-risk participants. This increases claim costs, which forces premiums even higher, causing even more low-risk customers to leave. This cycle is known as adverse selection. The solution to this problem is risk classification. By grouping exposures according to their level of hazard, insurers create homogeneous groups, where the risks within each group have similar characteristics. Without a proper and objective method of classifying risks, the insurance system would gradually become unstable. It would eventually suffer from adverse selection, leaving the insurer with mostly high-risk policies. To prevent this, underwriters follow a systematic classification process. Risk classification begins by grouping risks that have the same type of insurance coverage, such as property insurance. These risks are then separated according to their degree of hazard or occupancy. The first requirement for any classification system is the use of actuarial factors. Every classification factor must have a proven relationship with the probability of loss. For example, in life insurance, age is an acceptable classification factor because it is directly related to mortality. Education, however, is not used because it has no statistical relationship with a person's life expectancy. This leads to another important requirement: objectivity. The classification criteria must be measurable using clear and widely accepted standards. This removes personal judgment and ensures that two different underwriters will classify the same risk in the same way. By using actuarially sound and objective criteria, insurers can predict losses more accurately. This also ensures fairness by making sure that similar risks pay similar premiums. Another important requirement is simplicity. An insurance company cannot create thousands or millions of categories for every small difference in risk. The classification system must remain practical and easy to manage. This creates a balancing act for underwriters. On one hand, they must recognize important differences between risks so that premiums remain accurate and fair. On the other hand, if the classifications become too detailed, each category will contain too few risks. That reduces the effectiveness of the law of large numbers, which depends on large groups of similar risks to produce reliable predictions. To maintain this balance, insurers group together risks that are similar enough to produce stable statistical results while still recognizing meaningful differences. The real job of an underwriter is to continuously balance statistical accuracy with practical risk classification. A successful risk classification system cannot remain unchanged forever. It must continuously adapt to changes in the environment. Consider transportation infrastructure. When a dangerous 2-lane highway is expanded into a safer 4-lane or 8-lane highway, accident rates usually decrease. A good classification system recognizes such changes. It also adapts to changing human behavior, technological advancements, and economic developments by updating its rating factors whenever necessary. These changes are also closely monitored by regulators. Regulatory authorities ensure that insurers update their classification systems fairly and responsibly. They require insurers to follow proper procedures so that customers continue to receive fair treatment. In the end, risk classification transforms the uncertainty of real-world hazards into a logical and scientific system. It ensures that insurance premiums are fair, reasonable, and based on the actual level of risk.
Congratulations! You have completed all the lectures in Chapter 2. Now it is time to test your knowledge.
Next is testing your knowledge of what you have learned in this chapter. We have prepared 10 questions to help you assess your understanding of the concepts covered in this video. For each question, we will read out the question and the answer choices. You will then have a few seconds to think and choose your answer. In the following slide, we will reveal the correct answer and explain why it is the right choice. So, let's begin with question 1. Question number 1. Insurers do not cover the emotional, sentimental, or psychological value of life or property because. Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option A. These values are not tradable and are highly subjective to measure. Please note that the insurers are concerned only with the financial value of life and property because emotional and sentimental values are highly subjective and hard to measure since they are not tradable. Next question, question number 2, fill in the blank. Gradually developing flaws are usually not covered by insurance because they fail to meet the requirement that a loss must be definite as to dash. Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option C. Time of loss, exact date. For a loss to be insurable, it must be definite as to time, place, amount, and cause. Gradually developing flaws are not covered because the exact date of loss, time, is uncertain. Next question, question number 3. Which of the following statements is incorrect regarding the characteristics of insurable risks? Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option C. To prevent adverse selection, insurers must group heterogeneous risks together in the same pool. Grouping heterogeneous risks together results in adverse selection, and that pools must contain homogeneous risks, similar exposures, to function effectively and measure loss probability accurately. Next question is question number 4. Which of the following terms is dissimilar to the other 4 options? Find the odd man out. Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option C. Wooden construction. Wooden construction is a hazard, a condition that increases the probability or amount of loss, whereas earthquake, burglary, lightning, and malicious damage are perils, the actual loss-causing agents. Next question, question number 5. In risk classification, how is the relationship between risk, peril, and hazard sequenced? Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option B. First, take into account the peril to be covered, then study the hazards relevant to that peril, and finally classify the risk according to those hazards.
Next question, question number 6. Which of the following hazard to peril pairs matches closest with the hazard method of packing? Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option C, marine transit. The hazard, method of packing, such as liquids carried in a bottle, is specifically relevant to the peril of damage under marine transit. Next question, question number 7. Underwriting decisions can be predetermined for a multitude of risks without much investment of time and energy on each risk due to. Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option C. A proper risk classification system. A proper risk classification system eases the task of underwriting because certain underwriting decisions can be predetermined, eliminating the need to exhaustively evaluate each and every risk. Next question, question number 8. Find out which of the given statements is incorrect regarding the factors considered in risk classification. Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option C. A risk classification system should remain fossilized once established to ensure long-term premium stability. A risk classification system should not be fossilized, It must be dynamic and suitably updated to reflect changes in the environment, like technology, laws, and emerging trends like cyber losses. Next question, question number 9. When starting the process of risk classification, what is the first step insurers take? Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option C, studying past loss experience to see what perils caused the loss and what hazards were present. Identifying and understanding hazards is the first step in risk classification, which is done by carefully studying past loss experience to see what perils caused the loss and what hazards were present. Next question, question number 10. Fill in the blanks. Insurance is a mechanism of pooling similar exposures where a balance must be achieved between dash. Read all the options. Have you chosen the answer? Pause the video if you need some more time. The correct answer is option B, scale, granularity. Since insurance is all about sharing of losses by a sufficiently large group, some balance must be achieved between scale and granularity. To explain more, scale means having a very large group of insured risks so the law of large numbers can work effectively to accurately predict future losses. Granularity means keeping the group specific enough so that only similar, homogeneous risks are pooled together, ensuring fair pricing and avoiding adverse selection. Striking this balance ensures the insurance pool is broad enough to be financially stable, yet precise enough to treat every customer fairly. You come to end of the questions for Chapter 2.
We came to the end of the chapter. Hope this video is helpful. If it is helpful, please like the video. Subscribe to our channel to get notification when we upload new video. Join our mailing list in www.insure.com. Please feel free to provide your comments and feedback for us to improve better. Thank you very much for watching the video.